So, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending? How do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. I'm Merrill Chandler, and welcome to the Are You Effable podcast. Welcome back, everybody. A brand new episode of Are You Effable? Your host, Merrill Chandler, and today we're going to be doing one of our installments in the series Into the Madness. Our Into the Madness series is going through myFICO, Experian, and TransUnion credit reports and consumer disclosures, right? I want you guys to know what to look for, what you're reading, etc. So today we're going to be talking about myFICO. We'll be back in just a minute, and we're going to be a deep dive into reading and interpreting the myFICO credit report. See you in a moment. Welcome back, everybody. Merrill Chandler here, your host of Are You Effable? And I want to make sure that you guys understand how big of a deal this is. Most people don't know what it takes to be fundable. We've talked about that how many times, right? But even when you're given the facts, even when you're given the data right in front of you, sometimes it's so confusing, or sometimes it's the truth is kind of hidden in little in bits and pieces, and we don't know how to connect all those dots. So in this Into the Madness series, we're going to go through the myFICO Advanced Credit Report. That's all three bureaus, the myFICO Advanced Credit Report. And in upcoming episodes, we're going to be talking about the Equifax, Experian, and TransUnion episodes, basically revealing all of the data points that the bureaus are collecting, and they're reporting about you. So let's get to this exciting version. So I'm going to share my screen. So I'm going to be down here in the little corner, and I'm going to share my screen so that you guys can see exactly what it is that we're looking for. Number one, and we're sharing our screen. Let's get rid of this one, and let's make this big and huge and happy. All right. So as we look, so what we're going to do is we're going to just scroll through. I have my producer, Sky Copier, has redacted out all the valuable information, and so that we can see the form and likeness of the report without giving away all the goodies. So as you can see, this report was pulled 9/16 of 2019. We've redacted out the information, but let's go to the second page. Now, this second page is the same for all reports who are the FICO advanced report. It's giving us the FICO score 8. Now, remember, this is the unweighted scores we've discussed in the past. The unweighted score is FICO's FICO score, but it does give us the raw data reading. So these scores right here represent the raw data. There's no waiting for auto loans or waiting for mortgages or waiting the data for a vertical or industry specific score. So that's one of the things that we'll be looking at, because we're going to be reviewing the several scores, so you understand how to read the scores and which industry specific scores they belong to. So this is FICO 8. They start out with, and then they show you what may be they consider a very important data for you, the revolving utilization. Now, this is not utilization included in your auto loans, your mortgages, your student loans. This is just revolving, your credit cards, credit lines, and charge cards. Here, this is showing that it's 80%. Now, good news for this borrower is that it's the same across all of them. When you pull yours, you may not have the same across all of them. That is going to be a problem. And for those of you who have attended my boot camp or are planning on going to the boot camp, you're going to find out that when you do your fundability index, right, we do an entire evaluation of your fundability. You're going to find that we want to round to the worst case scenario. So if one of these were 60, if Experian were 60, we want to round to the worst case scenario, which in this case would be 80% utilization. But yeah, that's all at getfundable.com. Click on the boot camp, or you can go directly there by going to You Get Fundable Bootcamp, or excuse me, getfundablebootcamp.com. All right, so now the next thing we're looking at, which is vital, because remember the FICO has 5 areas that it evaluates, and so it's kind of putting those: what's the score, what's the utilization, and then we're looking at new credit. Now, these inquiries are posted to your credit report in the last 12 months, and it's a rolling 12 months. So 12 months from now, one of these would fall off after it hits its 12th birthday. Here's the problem with what we're being led to understand. FICO only evaluates 12 months worth of inquiries for its score. It does not, but remember, inquiries count against you for 24 months on underwriting. That next time when we review your consumer disclosures from the bureaus independently, you're going to see they keep 24 months worth of scores, because lenders want to know, how long have you been chasing money? Remember the look back period: 3, 6, 12, and 24 months. FICO's only scoring 12 months of it, but the bureaus are keeping 24 months worth of inquiries, because the algorithm for lenders is scoring all the way back through that 24-month look back period. All right, so in this case, these inquiries, notice each one of these are individually specific. So this borrower, when they pulled Ally Financial, this lender only pulled 1 score. Same with this auto loan, same with the University Federal Credit Union. You'll find in this case, each one of them pulled only 1. Now, if there were a Capital One, you'd probably see 2 credit pulls, because Capital One believes in belts and suspenders. In this case, there's only 1. Now, if there were a mortgage in here, it would be across all 3. So you want to count, whenever you're counting a number of inquiries, there are 2 counts that are important to you: total inquiries across all 3 bureaus. So in this case, 1, 2, 3, 4, 5, 6, 7 total inquiries. But the other measurement is, how many inquiries in every 6 months have you gotten? Because that's what FICO measures over the last 12 months. And there are and it's important to understand, we want to keep those inquiries down to a minimum. We've discussed in previous episodes where 2 inquiries per year, once per 6 months. So so I would tell this borrower to chart it out and see how many you're getting. Notice, here's 1, here's 2 days later, here's 3 days or 8 days earlier. So it looks like this individual was shopping for a vehicle. Notice that. So we have 1, 2, 3, 4, 5 within 8 days. 5, all from Experian. So what is that doing? That's just pounding Experian as a bureau, and so you're going to trigger some negative indicators there. The CBNA and the Citi cards, notice there's a TransUnion and an Experian. So in this case, same day, CBNA and Citi cards, looks like Experian pulled, or excuse me, CBNA or Citi cards, like I said earlier about Capital One, pulled 2 inquiries. Now, part of the reason why they do 2 inquiries is if your risk rate is a little high, which we'll get to in a minute. If your risk rate is high, they want to check the data. They want to compare one versus the other. Now, problem is, take a look at this borrower. As we went over the range between scores, we want it to be under 10. This is 2 points apart. So the data is faithful. So Citi, when they pull this, are going to see 2 relatively close scores. We'll go into more detail when we get to the line of credit scores or the bank card scores. But notice they pulled 2 of them because they want to make sure that they're getting a good read on all of the data. Now, notice that of all of these inquiries in that period, Ally Financial approve this borrower, and city approve this borrower. And notice it says it's reporting to all three bureaus. That is vital. We do not want to engage any institutions, any lenders that don't report to all three bureaus, because it'll cause that very range to increase, and we don't want it to be over 10 points. And we believe, based on anecdotal evidence from students and clients, that we get kicked out of automatic underwriting into manual underwriting when there's more than 20 points. All right, so let's continue. Now we're going to kind of enumerate the negative items. Now these are opened or closed accounts, so we want to make sure that it's apples and apples when we compare. Negative accounts: Bank of America, Mountain America, and Wells Fargo. So notice there are two burned tier 1 accounts here, lenders, and one tier 3, which is a credit union. They're reporting to all three. So those burned lenders, we have to build those relationships back up if we ultimately want to borrow from either the Wells Fargo or the Bank of America ever again. We need to make sure that we repair or revisit and renew those relationships. Now, here we have multiple collections, and it's telling us which ones they're reporting on. Mountain Medical is on 3, 2 for DirecTV, 3 for Intermountain Healthcare, 3 for Comcast and Intermountain Healthcare, TransUnion, and Experian. Now notice that Intermountain Healthcare here, same designation, Intermountain Healthcare. This one is reporting to 3, whereas this one is reporting to only 2. Could be different departments, could be radiology versus surgery. I don't know. I don't know what's going on with this borrower's life, but you guys need to know that there sometimes it appears that there is no rhyme or reason between the reporting practices of what would appear to be the same lender or the same institution, like Intermountain Healthcare. Now, there are no public records, so we don't need to go into any details there. But if liens, judgments, or bankruptcies were present on this, there would be another. See, notice this is negative account for a trade line that is. These were all revolving. These are collections. There would be another line and it would show public records and list them all. All right. Now, once again, they're showing the same FICO 8. FICO 8 score is the most widely used FICO version. Now, this is a little deceptive because this is the marketing version. And FICO score 8 is purchased literally by hundreds and hundreds of financial institutions as their marketing or their goodwill score, right? It's that FICO score that we've talked about in previous episodes and in my book. Well, here's the thing is they are saying it's the most widely used FICO score version, but this one is technically the most widely used because it's the marketing score. There is no count, and FICO, when I was back at FICO World, there is no count as to how many institutions use 542, how many use 8, and how many are using 9. They are not willing to share that information, but they are saying that this unweighted score, this FICO score, is the most widely used score version. So there's that. Now, this is really important. We're going to be taking a look at the factors, right? These are the up errors and down errors that I talk about with my team when I'm training them and students and clients in boot camps, etc. So your factors, it's basically giving you the big positives and big negatives, the 1,000-foot view of your profile. So you have an established credit history, but notice there down later it says you have not established a long revolving account history. So basically what they're saying is, hey, you got something. And this is only recorded. Remember how I talk about the FICO 40? You're going to see some of these designations here little by little, because the FICO 40 is different. There's like 38 in one bureau, 41 or 42 in another bureau. and they use different ones because they have different or they have different original metrics. And FICO 8 software version has kind of brought them all into one. But notice TransUnion, the established history is the same across all three bureaus, but only TransUnion counts you just having a history. Everybody, so notice these mean it doesn't matter. There's no data points, but your oldest account was open 5 years 4 months, and that means in 6 months from this date, it's going to go past that 6 years, which is a very important date when it comes to your aging metrics for your accounts. Remember, 2 years, 3 years, 6 years, 11 years, and 25 years. So the oldest account has been open for that long. The average age of the accounts is 3 years and 2 months. So at the time of this credit report, it was just barely had topped that average age had just gone over that 3-year mark, and so that it was a significant boost to this borrower's profile. Now guess what? You've recently been paying your bills on time, so that's an Equifax metric and an Experian metric, but it's not a TransUnion metric. Are you starting to see the patterns here? Your most recent missed payment happened 3.5 years ago. Okay, 3 years 5 months ago. Not a metric covered by TransUnion. So once again, we're looking at how they are, the different bureaus are comparing different pieces, and they're calling recent within 3 years, 6 months. That's 41 months at this point. So again, important to realize that we don't go by score, because each bureau is having different scores, different modeling, and we want to build a perfect and fundable profile, and then the scores will follow. But notice all over the place, there are different measurements by the different bureaus. Now, the first down arrow is across all three reports. You have a serious delinquency or derogatory indicator or public record and or collection on your credit report. Well, we know this borrower has collections and late pays or charge-offs. So it's across all three. The number of accounts that were ever 60 days late or worse, a significant derogatory account is 60 days. They're not saying here in this overview what's 30 days late. In the details, they'll show. But here, they're just saying 60 or later is a serious indicator spectrum. Now, direct answer to my question, what is a serious delinquency? And everybody at FICO told me 90 days. And then at the exact same time, they're saying they're calling this 60 days late or worse. So mixed messages there. They've told me 90 days or older is a serious delinquency, and yet they're measuring 60 days or more in the big picture. How many collections do you have? Well, we already saw this. There were three. There were three collections on Equifax, as we see up here on Equifax, but 5 on the other 2. So there's a differentiation on that. Made heavy use of your available credit. That checks out on all 3. Ratio of your revolving balances to your credit limits. It's 80%. So that is revolving balances. Just like it said up here, we're only counting revolving utilization for these major metrics. All right, let's continue. You have a recent public record or collection. So notice this is different than what was up here, serious delinquency. This has a serious delinquency. These two definitely have public records or collections. And down here, they're counting those public collections. Equifax doesn't use this indicator. And then your most recent collection occurred 8 months ago. It's irrelevant for the purposes of Equifax. So once again, we're seeing different uses of these data points, and FICO has basically brought them all together into one evaluation of the health of your profile. All right, so you have a short credit history. Now that's on both Equifax and Experian. You have a short credit history, but up here you have an established credit history. So notice that TransUnion says you have an established credit history. It's the only one, but you have a short credit history. That's how they give them credit. You see, it's totally hilarious how one casts it in a positive light, gives it an up arrow. The other two give it a down arrow. Oldest account, 5 years, 4 months. Average age of your account, same thing. Those were done up here. So the data is the same, but they're evaluating it separately. You follow me? They're evaluating it. This one's in positive terms. You have an established credit, even though it's not long, and these guys are knocking this borrower for having a short history. Then the next one was you have too many credit accounts with balances, and that's only being counted by Equifax. Number of accounts reporting a balance, 9. TransUnion and Experian do not use that metric. Now, as you go through yours, I tried to get the biggest. There's positive accounts, both positive revolving, positive installment, and there's negative revolving, negative installment, and collection. So I've tried to get a report that was representative of the biggest possible scope. But you may have different. You may have a similar profile, but you may have 15 years of history. So I'm giving you the best analysis that we can, given that there's 40 characteristics that they're measuring, right? All right, so now that was factors. Let's go into the ingredients. So here's the payment history. And this is the 5 areas, right? Your payment history. This is what FICO preaches all over its websites, everywhere you see it. So they're couching all this in terms to match what they share out there. But these are not all the fundability metrics. But I do want to go over them. There's payment history, 1, amount of debt, 2, credit history length, 3, credit mix, 4, and where'd the other one go? Oh, an amount of new credit. So 1, 2, 3, 4, and 5. Those are the 5. So we'll go through them in order. Late payments, 30 days or more, 3. 60 days or more. Derogatory public records, none. Collections, we saw that there was differential in those up above when we looked at it. Notice these days sync up. Yours may not sync up. So those are some of the data points that we want to make sure are legitimate. All right, we got to make sure that we're reporting similarly across all 3 bureaus. Accounts always paid as agreed. 75% of this borrower's accounts are paid as agreed. The amount of debt is fair, meaning there is compared to all of the indicators, she has 2158, and the amount of debt is based on limits. So accounts with balances, this includes good credit and bad credit, and includes revolving accounts and installment loans. Total balance on revolving and open-ended debt. So notice this is just open-ended debt is 2152. So it's only fair instead of good, excellent, or otherwise. Let's see. The total balance on is 2158. That's 80% utilization, and 80% utilization is no bueno. Now it's not poor. 90% or higher, I believe, would track a poor, but we want to be in excellent, which is in that without being a client, without being in my system, that we tell everybody 7% on the reporting date. Now, please forgive me if I've been pointing out a number of these things are going to be in the written version on our website, getfundable.com, podcast button, and you'll be able to see the written word, the written version of this evaluation. But please forgive me if I've been saying, did you see this? Did you see this? Because some of you may be walking, exercising, and or climbing Mount Kilimanjaro. So I need you guys to I'll be really attentive. Thank you, Sky, my producer came over. She was having your back and making sure I'm serving our listeners as well as our viewers. All right, so credit length history is fair. Remember, the oldest account is 5. We need these to be the average age over 6, and the and good to excellent is going to be average age over 6, and oldest account over 11. So, and usually we want no accounts under 2 years old, preferably when you guys are fully optimized. We want no new open revolving accounts under revolving accounts under the age of 6 years. Every 24 months, we would like to engage a new installment loan. So you got to go to our installment loan section and a podcast to review some of the information there and see what those parameters are. And of course, we deep dive in both my book and the boot camp. All right, amount of new credit. Now this is very good. Notice this is very good with 0. She has 0. Good is 1, and even 2 recent inquiries. It is and those recent inquiries, remember, they count within 12 months. Actually, I'm sorry. Forgive me, that's within the last 90 days. So good is 1 to 2 inquiries. Very good is 0 inquiries in the most recent. And then age of the most recently opened account. This borrower has 10 months aging. And of course, as I said, we don't want anything under 24 months on the revolving account side. And we want to grow that all the way to 6 years. Then we want a new installment loan, basically every 24 months. All right, where possible, of course. So now let's consider her credit mix. Credit mix is very good, and the next one after very good is excellent. So she has 3 revolving accounts, and remember, the perfect profile is 3 to 5. She has installment loans, including mortgages, that are a total of 9, and that installment loans, those are auto loans, 1, 2, 3, however many auto loans, as well as student loans, and bank issued credit card accounts. Now, remember how I said in previous episodes that the bank issued credit cards are your higher value cards, right? These are not retail or merchant or finance company cards. So the revolving accounts she does have been from banks. All right. So continuing right along, then the next section, you're going to see your risk rate. Now, her risk is 25%. If you're in the 800s, you're going to be in the 1%. They never have 0% risk, just so you know. 850s across all 3 bureaus, auto loans at 895 credit scores, because they go from 250 to 900. You're still going to have 1% of risk, but she's at a 25% risk ratio, and which is notice is orange, and then it goes to red. So they don't take their risk very lightly. Now, to kind of see through the illusion of this, you need to read the chapter in my book about how the credit scores are designed to make lenders money at the average borrower. That's 700 to 710. So you need to check out that chapter in my book and the corresponding podcast in this series. So we do 25% is orange on its way to red, and there's green, yellow, light green, dark green, light green, yellow, orange, and red. All right, let's go through. Now we're going to look at the scores by version. All right, so we're going to look. We are going to look at the across all 3 bureaus in some instances, but we want to look at the versions. Notice FICO Auto Score 8. We have 605, 612, and 628. But when we go to 542, 613, 602, and 592. So I'm just going to click between these and notice 605 to 613, 612 to 602, and 592 to 628. So Experian is the largest jump, but notice that these two switch, the 602 and 613 flip-flop. Now we're back over here at 605 and 612. So the different auto scores have different metrics. And to quote my partner Brad, it's guys, older scores are dumber, says Brad, and it couldn't be closer to the truth. They because they have hundreds of millions of more data sets to examine and compare for predictive analytic purposes. Now let's take a look at what they're actually measuring. So here, FICO score 8, you have serious indicators across all three. You have a short credit history. Remember up above, it said that on Equifax, but it's not saying that here, which means that his auto score, the borrower's auto score, is saying that it is a long enough history under Experian for the autos, right? But if we go down to the next one, you have a short credit history. Experian says 542 says, yep, it's not long enough. Do you see how they're evaluating different criteria between the bureaus? So all you want to do is compare and contrast the various auto score 8, 542, and 9. So short history, missed payments, heavy use of revolving at 80%, not established a long revolving history. Now notice, this is an auto loan score, but they're evaluating in FICO 8, they're evaluating revolving account history. There is crossover, even though this is a weighted score. Let's go to the next one and see that we're looking at this, and notice there is no indicator corresponding in it. You have not established a long revolving history, it says there, and here it says you have. Notice there is no version that says you have not established a long revolving history. This one does say you've got derogatories, you got a short history, a recent public record, you've made heavy use, and missed payments. Notice those are 3 versions of missed payments. All these 2 are from different bureaus. Now, what I need you to understand is I've sent you there before. If you want a copy of the FICO 150, all you have to do is go to getfundablebehaviors.com. Getfundablebehaviors.com, and that will lead you. Just tell us where to send your where to send all of these behaviors, because I'm going to show you 150 of these all in one place. Here, one beer. These are like paints to paint with, right? There's a palette of 150, and these are the ones that apply to this borrower, and which auto scores and versions apply to this borrower. Now notice, let's go down to the next one. This is auto score 9 now. Look at the scores here. We've got 611, 594, and 602. Then we've got 613. So right now, we have 611, but now 594 to 602, we've got a little bit of range in between all of these. And each one of them have their version across the reporting metrics of all 3 bureaus. So not enough established history is used by all 3 in FICO 9, where an established revolving account history is not used in 542, and it is used in FICO score 8. There are some crazy variances, and this is FICO testing every version to create predictability. All right, so now let's look at the bank card scores. Now these are weighted. Now notice that none of them are very far off the mark. We had the 602s, 594s, etc., but the bank card scores are closer. We had 20-point differences in a couple, 592 to 628. We have some huge differences over here on the Experian, huge differences. But when you get down into the credit cards, we're back to 4-point difference. So this 4-point difference, it indicates that the data and the behaviors of these revolving accounts are more parallel. And then, of course, we have all of the negative indicators. Now, this borrower has negative indicators across all of these. What I want you to understand is that these negative indicators are written differently than the ones you're going to get from the getfundablebehaviors.com. Those are the secret behaviors. Now, when I say secret, they're secret from the secret from borrowers. Lenders have had these for decades, but this the secret behaviors, the getfundablebehaviors.com is going to show you that this is not necessarily the language that is officially used by the lenders. They're forgive the language, but they're dumbing it down. They're making it more simple. They're making it more comprehensible. But this is not the language that the actual reason codes and behavior indicators share on those. So shares on the FICO document that you'll be you will send to you. All right, continuing. Oh, and FICO 3. So bank card scores. We had the bank card scores 8, bank card scores 542. There's a random Experian 3 that is used for bank card scores. I tell a story in my book about a Wells Fargo banker underwriter who shared with us kind of the metrics, and he totally saw the use of the marketing scores, that FICO score, and then what they would mark it, and they would send in things saying your score is blank, 720. They would send as a notice, doing marketing and doing a solid to the borrower. But when they actually pulled the report, they would pull, Wells Fargo, at least in Southern California, was pulling FICO score 3 to actually do the deal. That FICO score 3 was literally could be dozens of points lower. And that was kind of got under the skin of this one Wells Fargo employee, because he's like, we're marketing, sending out, hey, here's your monthly score. By the way, this score may be, and they use conditional language, this score may be good enough to get you qualified for the best interest on an auto loan. And then they go pull it, and they pull some random. And this is the most ancient of all the scores, right? And notice what it even says here. Right here, let me bank card scores. FICO bank card scores are widely used in credit card lending. So it says just generically. It doesn't say this bank card score. It says bank card scores are widely used in credit card lending, right? Then it comes down here and says these previous score versions are widely used in credit card lending. Then it comes down to 3, and it says FICO score 3 is commonly used in credit card lending. Notice how unspecific this language is, right? This language. So, and then what we're looking for is, and that's not the worst of it. These previous scores do show the same derogatory delinquencies, collections, heavy use, past due amounts, and collections. Notice this is revolving credit it's talking about. Revolving credit, and they're only on Experian. Experian pulls this file over here. Equifax and TransUnion do not use the equivalent of a FICO score 3. All right. So continuing, let's now hit up bank score 9, and scores are similar across the board. All the indicators are here because FICO score 9 really is bringing all of the scores into one and creating a homogeneity. They're creating a uniformity between all three of the bureaus, Equifax, TransUnion, and Experian. So where that is not the case when you look up at any of the other scores, FICO 542, FICO 8. Look, even FICO 8 is all over the place in the different indicators. But when you get down to FICO 9 has every one of them across the board. So there's a synthesizing going on between as each new iteration, each new software version comes out, they're creating more and more clarity. All right, so let's continue down into. All right, so now let's get down into our the accounts. So I'm going to show you how to read the several different accounts. If there's a green automobile, this means that it's an installment loan and not a mortgage. This borrower doesn't have a mortgage. If it has a house in here, if it has a house, it's a real estate back. So that could be, and this is where it gets a little confusing. Sometimes mortgages are listed like a credit, a home equity line of credit, a HELOC, could be listed as a mortgage on some bureaus, and on other bureaus as a line of credit. So it could show a revolving account here for a mortgage. So you gotta know the definitions and know what they're looking for, so we can accurately reflect what it is they're measuring. So if it's an auto loan, then this is not just autos, but it's all personal loans. It's all non-mortgage. If it's green, that means it pays its account as agreed. Paid or paying as agreed. This account is in good standing. Now notice that each one of the bureaus says it differently. Pays account as agreed. Paid or pays account as agreed. This account is in good standing. These are different languages based on bureaus. So Ally Financial, we'll learn shortly. Notice this is an auto loan, a vehicle loan. But there are no delinquencies. But if it says no update received, then that means that so no information is bad information. And in this case, the coaching for this client would be to make sure that it's saying none reported across all three. No update received means that they don't know. And remember, there's credit reporting bureaus and the data, credit scoring, and just for belts and suspenders case, guys, I want, where possible, I want there to be no material differences. Now, up here, the words are different, but there's no material differences. Here says a worse delinquency, none was reported. Over here, no update was received. So we don't know whether or not they're counting that against you. The balance is $24,947. There is no credit limit because that is because it is an auto loan. So we'll get down here a little bit further. Now, this 2-year revolving accounts, we'll see this differently. Now, notice there's your first evidence of the 24-month look-back period. 2-year payment history. And this is a rolling 2 years for FICO reports. Or it'll be the most recent 2 years from the date it was closed. So if you have one that says, and I think there's some in here, if you have one that says it closed in 2015, it'll go from 15 to 13, 2013 in arrears 24 months. So this one was recently engaged in January of 2019, and it's got all of the right things. Not reported means that it has not been reported yet as of the date of this report. Remember, this date was September. Now, notice Experian will always be ahead 1 month in its reporting date. So do not freak out if you find that there are different balances sometimes, etc. If there are significant changes month over month on a particular account, Experian may be reporting 30 days before Equifax and TransUnion are reporting. Now, this varies by client, so there's not or by borrower. There's not a universal way to say it. But many of you will find that one of the bureaus is ahead of the other, and I'm not going to. I can neither confirm nor deny that it's always Experian. All right, so there's the 24-month look back period, and then there is. So here's what it's saying: not reported, not open. Here is your here is the legend for how to interpret those accounts. Now, here are the more salient details. This is the open date. We want to make sure that our open dates are all the same. Last activity, 8 of 2019. It was reported again in or the credit report is of September. Here it's not saying that there's any activity, so that's something to check. The terms is 75 months. TransUnion doesn't necessarily report the terms of an installment loan, at which a vehicle loan falls in. Schedule payment and the balance. So there's the balance, and I'm sorry, this is the high balance. Now, a high balance means what was the loan amount for installment loans, and for revolving accounts, it means what's the high watermark? What did you, if you have a $30,000 credit limit and you used, in this case, $27,144, that they're going to keep that there. You never want your high balance mark to ever be more than 38% of your balance. But there you go. Loan type, but in this case, this is an installment loan, so high balance is the loan amount. It was a vehicle loan, and it is joint responsibility between the borrower and another person. Company name, Ally Financial. Notice sometimes contact information for this particular lender will be found down here in the contact information. You can write them or you can call them so that you can do whatever dispute or otherwise. It's handy to be able to get that information as much as possible. So that is the analysis of a true auto loan, an installment loan that is green, that is in good shape. Let's take a look. So here's a America First closed, and closed always shows up here as the indicator. Again, we can look at all the information there. Its pays account is agreed, but notice down here that this actually went to 2 months in advance, or 2 months faster than TransUnion and 1 month faster than Equifax. So you've got to make sure that you understand where your account, this has to do with the reporting date. You want to make, and the day you pull the credit report, etc. Because remember, this credit report, when you pull it, it is doing the analysis as of that moment. You want to, and so based on how fastidious you are, you can find out when all of your accounts have reported for the month, and then pull your credit report after that. All right. So there's nothing else to look at here. This one is showing that it's closed, that there was a close date. It's not showing it was closed on that. So I would recommend that you make sure that it's reporting a close date across all three, because up here it's saying that it was positive, it's closed, but we don't want to have any confusion as to what that looks like. So we would like to have that close date. The open date is the same across all of them, and last activity. So not too much. The terms, it was a 12-month loan, and it was a joint account. All right. Notice that was a 12-month loan, and it was also a vehicle, as it says down here. A joint account. Oh, other loan type. Could have been motorcycle, could have been a personal loan, etc. Account number, none listed, and here's your contact information, etc. Now it says account closed at consumer's request. This is if you're going to have a closed account on your profile, you want to have this indicator as that. That's the indicator we want. We do not want where it says account closed by a credit grantor. If it says that, that's actually a negative indicator, because think of it. You're a lender, you're reviewing a credit profile, and it says this account was closed by credit grantor, and you're like, I don't know what happened. Did they charge it up? Did they mess with it? What's wrong with this borrower? So FICO and lending software discount this. If it's closed by credit grantor, it's no bueno. So this one we like. This one's solid. All right, now let's look at a negative indicator. This one is a credit card that was charged off. Now notice again, language is different. Charged off as bad debt, unpaid balance reported as a loss by credit grantor. Guess you can't get more different than that, even though they're all the same. This one says 128 days past due, none reported, no worse delinquency, charged off, or other derogatory. So any account that is different, reported differently, remember, there we don't get into credit disputes. We certainly recommend that you do enforce your legal rights, but we don't have a disputing strategy that is designed to have legal and lawful items removed from your credit profile. You do have the right to only have legal and lawful items reported to your profile. And what that means is if there are any errors, if there's any inaccuracies, or if there is something that's not verifiable, those have the right to come off. And so I will leave you to your good graces to if there's something in error, inaccurate, or not verifiable, then please exercise your rights under the Fair Credit Reporting Act and feel free to dispute. Be very careful about using third parties, credit repair companies to do this stuff for you. Oh my word. You know I come from Lexington. You know I know credit repair inside and out. And I'm telling you, you don't want to have the things on your credit profile that are going to interrupt your fundability. But fundability means that if you are able to remove some things and you're not able to remove other things, you can still have an optimized profile. That's part and parcel of what this is all about, guys. We can have an optimized profile. Okay, so that's why I don't spend a lot of time on credit repair activities. It's just nonsensical in most cases. All right, then, but notice the balances are the same, the credit limits are the same. So this is where you're seeing your credit limits. So the current balance over the credit limit, so 95% utilization. This is that's what it got charged off as. So notice down here, TransUnion isn't rating it at all because it was charged off. It's account non grata, right? Persona non grata. But Experian has been counting it as a charge off for this entire time. Now so all of 2019, 2018, etc. Now you want a charge off. Some of you may run into something that looks like and this is an advanced strategy, but some of you may run into something where it continues to show 120 or 180 days late, but up above it says account charged off. Well, you've got to reconcile those things, because the date that this will fall off your credit profile over time is based on the charge-off date plus 6 months. So you have got to find out what those dates are, and you can't have a what we call a rolling 30, rolling 60, rolling 90, where it just keeps reporting the same derogatory account over and over and over. But legally it's been charged off, but they're not reporting it accurately. So that's an advanced strategy to be aware of. Now, when you get down into the next page, again, here's the earlier versions of when it got charged off. But notice there's data here, guys, for the times that they have been 90 days late or more. And so the question becomes, do these all reconcile? Notice there's an 8, there's a 7, there's a 6, 5, 4, 3, 2, 1, 12, 11, 10, 9, 8. So it looks like those that you're looking for accuracy in your data. But notice TransUnion, it's truly, so this is saying it's 90 days late. This is that rolling that I was telling you about. TransUnion said it's charged off. It's legit. It's gone, right? This one's saying it was closed on a particular date, on the date that it was charged off. These are not showing charged off. They're showing that these are rolling late. These aren't, that's not okay. And your credit profile doesn't age. You don't get 24-month look back period helping you, because for both Experian and Equifax. And this is common, guys. This is common if this is happening to you. These dates are extending your 24-month look back period further and further and further, whereas TransUnion has written it off. And that's a close date, and then traction after that. So there are strategies to do. Again, this is not to review disputes. I'm trying to explain what you're seeing and what to watch for. That it isn't about disputing. This is a phone call to your creditor, not writing a dispute letter to the bureaus. This is calling the creditor and saying, hey, you guys charged this off. Why are you continuing to say that it's 90 days late? Super, super important. Your open dates, date of last activity. Notice this is even saying the date of last activity was 5 of 15. This says 7 of 15, but it doesn't reconcile up here. It's saying that it's currently on this very bureau. It's saying that it's still late. So those are the things you got to watch for. And now you can at least see what's happening. Term, these guys don't have an indicator. This one's calling it revolving. High balance, it's a credit card, individual account, and Bank of America. All right. Now, this one was closed at what? Credit grantor's request. We don't want, this is not an indicator, but it was charged off. So, of course, this is going to be the indicator, but this is not good. Besides the charge off, this actually awards off any new credit, any new opportunities, and gets in our way over time. So there are more cards. We've got positive cards in here. So that's where you see the credit card as it's green and it's a credit card. So all those same indicators are all in there. Notice, once again, Experian is ahead of the reporting game. And let's see if there's last activity, revolving. Everything seems to be in order, but this is all the things that you can find. Now, notice it says City Cards CBNA here, but remember up above, it says City Cards CBNA here, but when we were looking at the inquiries, they had inquiries from 2 different versions of that account or of that institution. That may also be, and now that I'm looking at this, when they pull 2 and the names are different and they pull 2 inquiries, they may be pulling one and then they're referring it to a different version, like unsecured versus secured division, or a lower value credit offering. There may be different divisions, and hence 2 credit pulls may be required based on the results of the first credit pull. All right, I don't think there's again, everything else comes into play here. And once again, let's see here. Oh, so Experian is 2 months ahead in reporting, or better said, TransUnion is 2 and Equifax are 2 months behind as of this reporting date. Now let's take a look at some of the derogs. I want to get down to the derogs, derogatory accounts. We've seen all of these. All right, so these are the collections. So this is the indicator for a collection account. You saw what it looks like. It's just red auto for installment loans or red credit card for bad credit cards. What we're trying to do here is that what we're looking for is what we want to, when you're evaluating your credit profile, what you want to look for is who is the original lender. Then what is on these collection accounts, who's the collection agency, right? That's hence the agency name. Is the same date assigned, and what is the original balance on this? Now notice it says paid on Equifax. It says payment after charge off is TransUnion, and then Experian says paid account was a collection account, insurance claim or government claim, or was terminated for default. So Experian has quite the description. Now, now Comcast is a service provider, and so there isn't going to be a Comcast. We don't recommend Experian Boost. We don't recommend using small non-lender trade lines or accounts to be reported to help you build your score. We're not interested in your score. We're interested in fundability. So Comcast, of course, is a unless you have Experian Boost, it's probably going to be on here only in case there's a collection, as in this case with this borrower. You want to find out when the date of last delinquency is, because the date of last delinquency is also going to indicate when it can come off, when it's going to ultimately fall off. If everything's accurate here and you don't dispute it, it will fall off after 7 years after the date of filing, or 90 months after the date of last delinquency. So you need to look up what those are. Then Intermountain Healthcare, notice it's only reporting, as we learned up in the collection section up at the top. Intermountain Healthcare is who the vendor was. IC Systems is the one who's doing the collecting. Everything looks to be the same. Equifax, it's not being reported to Equifax. And hence, that's one of the contributions as to why there's a range in scores. All right. So finally, let's look at here's another view of our inquiries. Remember, notice there's no inquiries under Equifax, no inquiries under TransUnion, except for an older one. And then Experian had all of them, and that was the extra hit. That's what's in our way, because this borrower isn't looking at all three bureaus to pull credit from, but only those that are using Experian. And so we're going to get denials because there's too many inquiries if they continue to pull from Experian. Now let's take a look at the personal information. Now the personal information, we've redacted some of these. Thank you again, Sky. But under the name, it was her first, middle, initial, and last name across all three. So she got lucky there, but one under TransUnion had her last, first, and middle. Now, remember, the former names, nobody fills out a credit application with last, first, or middle. So many times this is a mistransposition. The data is transposed in data entry. Like if you do a paper application and you fill out that paper application, and we may put in they may ask for our first, middle, and last, and then we enter it wrong, or the transposition happens incorrectly in data entry, and we end up with a completely extra identity. No bueno. Now, the date of birth, we pulled that out, but those were all the same, as were the Social Security numbers. Now, notice here, what you're going to be looking for in your current address. This current address was the same across all three, but notice the move-in date was 10/1 of 17, 9/1 of 17. See that? Versus 10/1 of 17, and then Experience shows 12/10 of 18, a full 13 months later. So 14 months later. This is not okay, because here's what happens, and you guys need to know this. If you're filling out an application and you put down, now there are worse versions of this. You got to go with me on this one. There are far, I mean, there's can be 5 or 10 year differences between here, but there's a full a year difference. So let's say that this individual is filling out a business line of credit, a credit application, and she puts in, oh yeah, I've been here since 9 of 2017. And they pull, as this borrower has been getting, they pull an Experian credit report, and Experian says, hold it, my records say it's 12 of 2018, but she wrote down, the borrower wrote down 9 of 2017. That is a red flag enough to get your application denied. So when you guys are looking up your myFICO.com credit report, look at that date. That date it starts your longevity points. If for however long you're at your current address or any address, you get points for being there. And for all intents and purposes, the facts, the anecdotal evidence that we have, it's the same 2 years, 3 years, 6 years, 11 years, and 25 years. So if we're in 2019 right now, and she's been there 2 years here, this would only be 1 year. She wouldn't even get the longevity points. So things you got to watch for. Again, here is 11 of 17, 3 of 17, and 11 of 17 at the previous address. And then there's Sandy. Now notice this one doesn't even sync up. There's nothing reported for TransUnion, and Equifax says St. George, but Sandy, Utah says Experian. Guys, every one of these things are important for us to evaluate. Now, here's one that one thing that is crazy important. Notice we have 2014. Now, this is like genealogy, right? This is a time, these are all timestamps. 2014, 2014. Oh, okay, we're getting closer to the future. 2015, absolutely. 2017, yes. And then we go back in time to a previous address. This is a huge red flag, especially on this Equifax report. We're going to be looking at this same borrower through the eyes of the Equifax report, TransUnion report, and the Experian consumer disclosure files. Whew. All right. Well, this podcast has taken a minute, but I want you guys to know how to look at your myFICO credit reports, the advanced versions of the FICO reports. Now, the final thing is that the current phone number and previous phone numbers are rarely, if ever, listed on myFICO, but there will be a grip of them for most borrowers on their consumer disclosure files. We'll get into that in future episodes. But notice, and yes, we're giving it away. This was one of my team members, but notice this is CreditSense misspelled, but the date is correct here, and the previous employer here is correct. So there is no employer under Equifax, and so each one of these is it's important for us to establish the right kind of protocols to list your W-2 if you're W-2, your QFE, your qualified funding entity, if you are one of my clients or students. Everything that we need to sync all of these up so that they are together and the CreditSense is spelled correctly across all three bureaus and or the person's QFE. So again, every one of my team members, when they join my team, we start out building their personal profile. So I want to thank my team member for letting me share her before. Maybe one of these days we'll share her after. But guys, that is the analysis and the rundown and review of what it takes for you to build, to interpret your myFICO credit report so that we can then build a fundable profile. This is not your profile. This is the report of your profile, and we need to sync all of those up. This is Merrill Chandler. wanting in every possible way to make you as effable as possible. You guys have a spectacular morning, afternoon, or evening. We'll see you next time. Hey guys, thank you for listening to Are You Effable? Please leave comments because I would love to read about your aha moments from this episode. And be sure to visit fundinghackers.com to view the blog post, get important links, join our community, and much, much more. And you gotta tell your friends about this podcast. We want them to become effable too.